Are you looking to transfer a buy-to-let property to your children, but want to avoid capital gains tax and inheritance tax? Great! Watch this video as I show you how. Hi there, my name is Simon Misiewicz from Optimize Accountants. I'm here to help you build your wealth and reduce your tax liability. In this particular subject, I'm going to be talking about transferring assets, which are buy-to-let properties, namely, from yourself to your children. And why should you be thinking about doing that? And there are several reasons. One, it helps your children get onto the property ladder. We hear constantly the news of people trying to get to the property ladder but can't for whatever reason. Well, if you have a buy-to-let property and you just do not need it, then help them get on the onto the property ladder, normal property ladder, for them to have a home. Makes a lot of sense. The second one is, if you've got children going to university, you might decide to say, well, hey, I will buy you a property or give you one of my buy-to-let properties, and going forward, you look after that property, you own it, and now you can look after yourself. Which, let's be fair, education is great for theory and hypothesis and literature and all that kind of good stuff, but which ones really talk about everyday money, even business studies for that matter? Not many. So giving them an asset, a buy-to-let property, your children will learn about money. It will enable them to charge rent to their fellow students, use that money to pay for their own livelihoods, and stops you from having to pay them each month. And let's be fair, you as a parent, all you're doing is paying tax on the money you give to them anyway. So is it not better to start the money education program with them by giving them an asset? And you could say, well, that's counterproductive, surely, because I'm giving them an asset. Well, yes, but at some point in the future, you'll end up giving the asset. So why not give it to them now? A legacy planning with IHT. If you give assets to your children and you stay alive for 7 years, then there's no IHT to pay. Brilliant news. And finally, Section 24 may be affecting your income tax position. You've got a buy-to-let property and you've been renting it out, but now all of a sudden you could be in a position, like many of our clients, that are paying more tax than they're making on the property itself. So again, what is the point of owning that particular asset? Giving your children an asset that they can use, whether they go to university or need a home, makes a lot of sense. Now, I talked about Section 24. You may be looking at this video and thinking, well, what's this? How does it affect me? Well, don't worry. There is a video on this subject, and it's appearing above my head right now, and the link below this video. So if you're worried about Section 24 mortgage interest relief cap, please go ahead and watch that video. And also, I talked about inheritance tax. For the basics of inheritance tax, about what reliefs there are, when you have to pay it, etc. I am not going to go into that level of detail in this video. It's just too long. So again, there is a video link for inheritance tax planning, which is appearing above my head right now and just below this video. So let's talk about taxes you will need to pay. And typically, if you give a buy-to-let property to your children, there are amounts of tax that you need to pay. I'm just going to get my scribe now so I can show you. So the first one would be stamp duty land tax. Now, if your children pay off the mortgage on your property, or they give you an element of money towards that property, there could be a stamp duty land tax charge. So a gift outright avoids that whole issue. There's no stamp duty land tax because there's no consideration. A gift is no consideration, therefore there's no stamp duty land tax. There will be a capital gains tax. So potentially, as you can see here by an example, there could be a £50,000 gain on a property that you've given to your children. And even though you've given it to them, you still pay capital gains tax. How awful is that? And that basically means you could have a capital gains tax liability even though you've given away an asset that was generating you an income. And finally, inheritance tax. If you gift a buy-to-let property and you die within 7 years, then that asset is bought back into your estate and then it could potentially be subject to 40% inheritance tax on assets over and above £325,000. Of course, we've got this other allowance of £175,000 for home nil rate band as well. Again, not going to go into much more detail than that. Please do check out that inheritance video I talked about earlier. So there are elements of tax that you really do need to think about before you give any assets to your children. All right, so back to the taxes in relation to giving a property to children. Now, what I've got here is the CGT will be immediately payable, and inheritance tax would be payable if you died within 7 years. But in this example, we're going to look at a situation whereby you've died within 3 years, and that is because you get no reliefs at all. So in this regard, we talked about a property that got a market value of £100,000. The purchase price was £50,000, and therefore you'll have a capital gains tax charge against that £50,000. Now, inheritance tax, that's an interesting one, because when people talk about giving away an asset, they think, well, CGT and that's it. Oh no, that isn't it. Because if you died within 3 years, as we're exploring here, then that £100,000 gift would also be subject to inheritance tax. So that £100,000 is now going to be taxable at the rate of 40% if it is in excess of your IHT lifetime allowance. So how do we avoid capital gains tax by transferring it over to our children? Well, it's about using a trust environment and utilising the legislation TCGA section 260, boring but useful. It will allow you to use your IHT lifetime allowance, or your PET as it would be called, instead of using your capital gains tax. So therefore you could avoid CGT but potentially use your IHT lifetime allowance instead, which is really, really useful. So the process is that you would put the property into trust. Now, for you to do that, you want to be able to have an unencumbered property. To have an asset into trust, unless the mortgage is equipped to be put into a trust, then you're going to have to pay it off. So in my view, have an unencumbered property and then move that into a trust environment, using a solicitor to help you go and do that. So really, unencumbered property. In this regard, you pay no CGT because you're using the TCGA section 260. So again, you do need to look at the tax law and make sure the paperwork is correctly done. There'll be no payment of SDLT because it's a gift. A gift means that there's no consideration for the property and therefore no stamp duty land tax. And finally, there's no inheritance tax if it's under your £325,000 personal allowance for IHT purposes. And this is 325,000 PP per person, by the way. So if you're a couple, you've got an allowance of £650,000. So there are bigger vehicles that properties that you could move into a trust environment if they're in both of your names. Once the property goes into a trust, you have to have the setup fee. Solicitor's fees aren't exactly cheap, so you want to do this on bigger properties, not small properties. You will keep that property in trust for a number of years. Now, if you're giving it to a young adult child, does that make sense? But your child, that's a young adult, they may not be savvy enough or from a finance perspective, or they may be dating someone that you don't like and hope that they get leaving them. So once they come to their senses on both fronts, you can then relieve yourself from that being a trustee of that property and then give it to them. But in the meantime, you could say, well, do you know what? In the first 9 years, I will become a trustee. I will look after that property. You cannot take risks with this particular asset. Now, the reason why I say 1 to 9 years is because if you've got a property into trust and it's in there for 10 years, you do have an extra tax charge, which is unnecessary. So you really want to do this within 1 to 9 years and then get it out of that trust. And as it says, at the 9-year period. You can do it sooner, so you could do it after a year if you like. After about a year, move that asset from the trust environment into their hands. But again, using a trust is a good way of safeguarding that asset from let's call them naive adult children. So what does this really do for us? Well, as we've just described, now we're using the TCJA 260, which means that there's no taxable gain because we're offsetting the transfer of the £100,000 against IHT lifetime allowance. And therefore, there's no CGT at all, no tax to pay. That's brilliant news. Now, of course, if you died within 3 years, well, it hasn't really helped you that much because the asset is still going to be pulled into your estate. It is going to be charged at £40,000. You have no CGT which you've paid, and therefore the full £40,000 would be payable if it's in excess of your £325,000 personal allowance for IHT purposes. So really, this is a vehicle to help you put a property into a trust and then back into your children's hands without you paying any capital gains tax liability whatsoever. And if you're interested to understand what CGT you would have to pay on gifting a property to your children, then why not download the CGT tax calculator for $9.95, and it will help you not only understand how much CGT you have to pay, but ways of mitigating that tax liability further. Don't forget to press the like button if you've enjoyed this video, or indeed subscribe to this channel so you don't miss out on any videos that we release. And if you have a question, then please feel free to type in your question below this video and I'll get back to you as soon as I can. Until next time, my name is Simon Misiewicz from Optimised Accountants. See you again soon.